Disney is a stock that I think we all have been familiar with for a long time. Disney, of course, has their theme parks. They have different media properties from linear TV, ABC, the channel, cable. They do their streaming service, which has been getting more streamers, which is good, and all those things. So, um, in general, I think Disney has a lot of valuable assets, but it also has like legacy. What I mean by that is it has some businesses that are not that great anymore. So we will take a look at it fundamentally. And Stefan, very good to see you. Thanks for joining, and thanks for being a member. All right, so we got Disney there at $204 billion market cap. This year they are in the green, which is a turn in the right direction because they've had a couple rough years. You see in the 5-year that they really sold off in 2022. Everybody sold off, but these guys never recovered. They had a CEO that came into the picture, and it didn't quite go well for him. And they brought back the previous CEO who had retired, and he's gotten the ship back in order. Their revenue's $94 billion, PE ratio 17, forward P of 18. They pay a small dividend, and investors think it's a strong buy with a small discount. They are growing a little bit. It is encouraging to see them grow, but it's not real incredible growth. It's just, beating inflation just by a little bit, which is not exciting. The gross profit is not exciting also. And I think part of it is when you run a big theme park, you got to pay for all the operating costs of that park. You got to pay for all kinds of expenses. And that really adds up and it really keeps your gross margins limited. And therefore, your profit margins will also be limited. Your free cash flow would be limited. And that's been one of the things that has made Disney a less desirable communication services business to me. I'd rather own Google Alphabet, Meta, which have tremendously higher gross margins, net profit margins, and free cash flow margins. So that's been one of the limitations on Disney. Let's see what analysts are saying, and let's take a look at their balance sheet. So their analyst community, 21 of them are covering the stock. They think it's 14.7% discounted if you average their price targets. And we look at their forecast. They have a fiscal year that ends September 30th. So they're kind of working on finishing this year in the next week and a half. It's expected that they're going to keep growing, but they're going to grow at small rates, right? So again, not overly exciting. Their PE isn't overly expensive. So this is a very well-known company. The good news about, Disney is everybody knows Mickey Mouse. Everybody knows that they're a good business, and their movies tend to do really well. Their new production tends to be successful. They don't go out and create movies that are going to change the world, so to speak. They kind of latch on to a particular genre and just really stick to it. A lot of kids' movies. Movies tend to be a lot of sequels, which kind of get a little old if you're a fan, but Disney's into making money, not necessarily being the best artist out there. So the business, it's I would say relatively well known and priced reasonably. I'll give you my valuation in a minute. I first wanted to take a look at their balance sheet. Let's take a look at their balance sheet. And this is where, we start dealing with how much debt do they handle. And they have $42.26 billion of debt with $5.37 billion of cash. Debt to EBITDA is 2. So It's within that. It's a decent ratio. I don't want it to be above 3 debt to EBITDA. This kind of in a general sense, it would take them 2 years to really devote their earnings before interest, tax, depreciation, and amortization. If they devoted that and didn't spend money on like growth or anything, they could pay off their debt. Not a bad ratio, but it's not excellent either. It's kind of like if you're in school, it'd be like a B minus, maybe a C plus. You passed, but you weren't one of the top students. All right, so we got through just a fundamental review. Now let's take a peek at what I think the business is worth based on all that information put into a valuation model. And looks like my friends over at Google are not updating my calculations, or I should say my lookups. So I got to refresh my screen and do that all over again. And here we go. So I happen to think that Disney's 25% discounted. So I'm agreeing with the analyst. I'm actually at a higher discount than they are. And this is all based on their free cash flows and also their earnings per share. I'm giving them a P at 24, and they're growing. Very well-known brand, very trusted brand. And I think the retail investor is beginning to get quite comfortable with Disney. And, at one time, I think Disney, geez, it must have been like 30, 40 years ago. It was one of the most valuable businesses in the exchange. So it really had great credibility then. I think it still has great credibility today. It's just not in the ideal business anymore. As mentioned, I'd rather have Meta, I'd rather have Google. But these guys, it looks like if an investor is interested in Disney, I think they offer a decent discount. And then last thing I'll say is as we consider, what's the economy going to do? Are we going to go into recession or not? And I think in recessions, people stop taking like vacations and so forth. And that could hurt Disney because I've taken my family to Disneyland. I'm sure you guys have as well. It's not cheap. It's a lot of fun. I'm glad I did it. But man, it really was an expensive trip to go to Disney World. I live in California. I could drive to Disneyland. We've had annual passes. And if things got tight, I imagine if I had a young family, one of the things I'd probably cut would be that annual pass. Or, hey, we're not going to go to Disney World this summer. We're not going to go next summer. Instead, we're going to go camping, save a few dollars, but have a good time as a family. So that's my fundamental review of Disney. Let me pass it over to Daryl, and he can take a look at the charts.
So excuse me. I'm looking at a 5-year daily price chart here, and I just drew this line across the top of these 3 peaks just to see where we have a line of resistance. It's hit that 3 times over the last, since September of 2022, and it keeps getting rejected there after surpassing that quite handily in 2021. But there were a lot of stocks that really ran up in 2021, probably beyond what they should have. So this looks like a respectable resistance line, and it looks like we're sitting about $10 below that. I'm going to just look at a year. We can see that it is trading above a 200, which is upward sloping after having been downward sloping for about a year. It's turned around now and is upward sloping. It's trading below a downward sloping 50-day and a downward sloping 20-day. In the last 2 weeks have looked like declining. Prices kind of be indicated by the RSI here, which is sitting at 38. I'd really like to have it hold right around 40. We can see that it dropped to 30 or so back in August. And I'm not even going to talk about the tariff because every company had that particular issue. But it'd be nice for it to hold right here around 40. But it is showing weakness on the RSI. It's also showing weakness on the PPO. It is in bearish territory, and it looks like it's accelerating into bearish territory because this divergence between these two moving averages is getting larger.
Mm-hmm.
So we might see continued weakness here for the next few days. Accumulation is sitting at a nice level. It had some distribution back from December pretty much all the way through May, and then a large amount of accumulation, and it's sitting at pretty much an all-time, not an all-time, 52-week high, 1-year high.
Mm-hmm.
So they are outperforming the S&P 500 by about 5%. They're underperforming the communication sector by about 10%. They're outperforming the broadcasting, not broadcasting, just entertainment industry by 9%, and that industry is underperforming the S&P 500 by 4%. To me, it looks like it's going to continue to trade sideways for a while, and there is a pretty significant point of resistance here around 123 to 124.
Excellent. So it's interesting that for the last 3 years, your charts are showing that resistance line on the upper end. That
Yep.
was really interesting. And yeah, so I mean, we're just sitting on a what I think is an expensive market, and Disney would not be the first stock I would think about. Um, you, right now I'm thinking, okay, I don't want to buy too much more at this point. I may want to sell some stocks. I'm actually selling a few stocks, and because I want to create a little more capital. If we have a substantial sell off, I'll be glad that I did so. But this one is I think I can't argue with an investor that said, "Hey, I like the Disney business. I want to hold it long term." That's a pretty good idea. That's a pretty good idea. I can't argue with it, but it's just not the first one I would make in this sector. I like Google. I think Google's has a lot of momentum. I think you could say that, hey, that's just gone up too much over the last 6 weeks. I agree with that, but it went up for a reason. There's tremendous value there, and it's got a strong grasp on the future. Google does. You look at the YouTube business; it's phenomenal, along with their other businesses. So, thanks for asking. Blocks are fun. That was a good one. It's good to. I always like talking about Disney. It's a good company. Feel good
Notice,
company.
notice the volume on Friday. So this was a triple witching day. So we had
Triple Witching Day. Please explain what Triple Witching Day is.
so when we look at futures, we're looking at a contract typically in the next quarter. So the futures contract for the S&P expired on Friday,
Mm-hmm.
and then you have daily options expiring probably for Disney, and you also had weekly, and well, it could have been a quad witching day because you'd had weekly expirations expiring and monthly expiration
Got
options
it. Okay.
expiring. So when all of that happens, you'll notice just about in every quarter on that third week, you'll see way above average volume. And that was definitely the case here. And one other thing I'll point out is typically the 3 days following monthly options expiration is typically your weakest period of any given month.
Mm-hmm.
So we saw a downturn on Friday. This doesn't surprise me because it was at least triple witching, and it may have been quadruple witching day.
Thanks. Thanks. Were you going to say something else? I think I interrupted your thought
Nope.
there.
Nope.
All right, perfect. Thanks, Daryl. Good stuff. Good stuff.